Welcome back. We're going to get started back on page 53. And what we're going to do in this session is we're going to talk about double entry accounting system, and we will actually begin by describing and illustrating journalizing transactions using the double entry accounting system. All businesses use what's called the double entry accounting system. This system is based on the accounting equation and requires that every transaction be recorded in at least two accounts. It also requires that the total debits equal our total credits for each transaction. The double entry accounting system has specific rules of credit and debit and credit for recording our transactions in the accounts, and we're going to start out by taking a look at those rules. Like I said, the double entry accounting system is based on the accounting equation. Remember our accounting equation, we have assets on the left side, and then that's equal to liabilities and owner's equity on the right side. Remember, the word debit means left, the word credit means right. So assets are on the left side of our equation, so if we want to increase our asset accounts, we debit them. Liabilities and owner's equity are on the right hand side of our equation, so if we want to increase those accounts, we want to credit them. So we have debits on the left, credits on the right. Assets normally have debit balances, liabilities and owner's equity normally have credit balances. All right, let's look at our income statement accounts and see how the rules for debit and credit affect them. Remember, revenue increases our owner's equity, so if we want to increase our revenue account, we credit it. Expenses decrease our owner's equity, so if we want to increase our expense accounts, we debit them. And then the other account we're going to talk about is the owner's withdrawal account. Remember, the drawing account decreases our owner's equity, so if we want to increase our drawing account, we debit the drawing account. So let's take a look at what our normal account balances are. Our assets normally have a debit balance. Our liabilities, again, it's on the left. Our liabilities and owner's equity both normally have credit accounts because they're on the left side of the equation. Our income account, the revenue account increases our owner's equity, normally has a credit balance. The expenses decrease our owner's equity, so they normally have a debit balance. There's an example in the book on page, it's on page 54. And we're going to take a look at that example real quick. And what we're going to do is state how the rules of debit or credit affect each one of our accounts, and whether those accounts normally have a debit balance or credit balance, and whether or not they have debit entries only, credit entries only, or both debit and credit entries. The first account we're going to talk about is the drawing account. Remember, drawing reduces our owner's equity. There's normally only debit entries in the drawing account. Very few occasions would you ever have a credit to the drawing account. And it normally has a debit balance. Accounts payable has both debit and credit entries because we're charging things, and when we do that, we credit our accounts payable, and then we pay on the accounts payable, and when we do that, we debit the accounts payable. And our cash normally has debit and credit entries, but our cash should always have a debit balance. The only way it could have a credit balance is if we're overdrawn, and hopefully that won't happen with you or your business. Fees earned. Remember, fees earned is fees are an increase to our owner's equity, so it would normally have a credit balance, and there's normally just credit entries in our fees earned account. The only way you'd have a debit in there is some kind of correcting account, a correcting entry. Our supplies, remember, are an asset while we're holding them, so it normally has a debit balance because it's an asset, but it does have debit and credit entries. We debit it when we buy supplies, and we credit the supply account when those supplies are used up in the normal operation of the business. Utilities expense, remember, expenses decrease our owner's equity, so they normally have debit balances, and normally there's only debit entries in our expense accounts. unless we're making some kind of correcting entry. Journalizing, a transaction is initially entered in our records in a record called the journal, and the process of recording that transaction in the journal is called journalizing. There's 5 steps to journalizing. The first thing we do is we put the date in the date column, and normally at the top of the date column on each page you'll put what year you're in. So we're in 2009 now, so we'd have 2009. Then you have a month column and a date column, and the first time you enter a transaction for the month, or at the top of each page, you'd put the month in the month column, and then when you make an entry you put the date in the date column. Beside that, there's a column called description, and that's where we put the titles of our accounts. The title of the account to be debited, and it's recorded at the left hand margin, and then the account to be credited is in the left hand column, but we indent a little bit over from the account that we debited. So the title of account to be credited is listed below the account that's debited, and then indented over just a little bit, and then the amount credited is entered in the credit column. And then right below our 2 debits and credits we put a brief description so somebody looking at the journal can see exactly what has taken place. The post reference, and in the journal it's just listed PR, is initially left blank, and we'll talk about that later when we get into posting to our ledgers. Now we're going to take a look at our transactions. Remember, the first transaction we had was Chris Clark took $25,000 out of his personal accounts and put it into a bank account for Net Solutions. So in Net Solutions, our first journal entry would be on November the 1st. So in our date column we put 2009 right at the top of the date column in the month column, and then right below that we write November, and the date column we put 1 out by November because it's November the 1st. Then in the description column we write the word cash, and then it was $25,000 debit to cash, so we put that in the debit column, and then right below that we indent over a little bit from cash, write Chris Clark Capital, and put a $25,000 in the credit column, and then below that we put invested cash in Net Solutions, and our post reference or PR column is left blank at this point. If we were doing this in T accounts, it would look like this. We'd have a T account for cash and a T account for capital. We'd have November the 1st and $25,000 in the debit column for cash, and November the 1st and $25,000 in the credit column of Chris Clark Capital. Always got to keep our debits and credits equal. The next transaction, remember Net Solutions went out and bought a piece of land for $20,000. So in the date column we already have November in 2009 in November in the transaction above this one. This would be listed right below. So all we have to do in the date column is put 5 and then land, and then it's $20,000 in the debit column, and then right below that we indent over a little from land and write the word cash because we're crediting our cash for $20,000. And then right below that we put purchase land for a future building site. Our next transaction took place on November the 10th. So in the date column we only put 10, and we bought some supplies for $1,350, but we bought them on account. So in the left, in the description column we write supplies and put $1,350 in our debit column. Right below that we indent over a little bit, put the words accounts payable, put $1,350 in the credit column, and then below that we put purchased supplies on account. The next transaction, Net Solutions received $7,500 from its customers for services rendered. So in the column, the date column, we put 18th, and then this money was received in cash, so we write cash and debit cash $7,500. Right below that we credit fees earned $7,500, and then we write received fees from customers. We're going to have to stop at this point, and then we'll pick back up with transaction E. My time's out for YouTube. So we'll stop here and pick back up with